400 million ounces. That is how much silver exists right now as paper contracts on the COMEX futures exchange. 100 million ounces. That is how much physical silver is sitting in the registered COMEX vaults that are supposed to back those contracts. 4-to-1. For paper promises for every single real ounce of metal. And while that ratio sits at those levels, Shanghai is paying $88 and change for silver that New York is pricing at $82. The metal is moving east. The vaults are thinning, and the open interest has not come down. In about 10 minutes, I'm going to show you exactly what happens mechanically when that ratio gets stress tested, and what the specific trigger level is that could turn a slow structural pressure into something that moves very fast. Last week I told you to watch the Asia Open Sunday night, specifically whether the Shanghai premium over COMEX widened beyond 6.5% or narrowed toward 4%. Here's what happened. The premium held. It did not spike dramatically, but it did not close either. Shanghai continued trading above $88, while COMEX sat in consolidation. The physical arbitrage, metal moving east, has not stopped. The registered inventory pressure I flagged last week has continued. I called it the less dramatic but more telling outcome, and that is exactly what we got, a market that is grinding, not exploding, but grinding in one direction. I am John, FX Insider. 15 years in currency and commodity markets before I started making these videos. Everything I tell you comes from that experience, and everything is backed by data you can find yourself. This channel exists because serious investors deserve serious analysis. Not cheerleading, not doom, just the numbers read plainly. If that is what you've been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed, do it now, because what we are building here week by week is a framework for reading this market that most channels are not giving you. Today we are going to the ratio that I think is the most important number in the silver market right now. Here is what we cover. What open interest versus registered inventory actually means in plain English, why the current 4-to-1 ratio is historically significant, what the $86 level means for the squeeze trigger, and what thin futures liquidity means practically for someone sitting at home with position. Everything from publicly available sources. I will name everyone. Let me paint the picture clearly, so we are all starting from the same place. COMEX silver spot is around $82 to $83 as I record this. Front month futures at $84. Shanghai at $88 plus. That east-west premium we covered last week has not gone away. Now zoom out from the price and look at the structure underneath it. COMEX open interest. The total number of outstanding silver futures contracts is sitting at a level that represents approximately 400 million ounces of silver. That is the paper side. The registered inventory in COMEX warehouses. The physical silver that has been certified and earmarked as deliverable against those contracts is approximately 100 million ounces. That is the physical side. 400 million paper. 100 million physical. Now, before we go further, I want to be precise about something, because this is where a lot of channels mislead their viewers. Not every futures contract is going to demand physical delivery. Most futures traders roll their contracts or close them for cash. The system has always operated with a fraction of physical backing. That is normal. That is how futures markets work everywhere. So the 4-to-1 ratio alone is not a crisis. What makes it significant, and this is the part worth understanding, is the combination of that ratio with the current conditions. Shanghai pulling metal east. Registered inventory already under pressure. A 6.5% premium that keeps the arbitrage trade financially attractive. And a macro environment where institutional uncertainty about dollar assets is elevated. Any one of those factors alone is manageable. All four together, against a 4-to-1 paper-to-physical backdrop, is a different conversation. Drop a comment right now. Have you looked at COMEX registered silver inventory data before today? And does the 4-to-1 ratio change how you are thinking about your current position? The comments section here is a real-time sentiment tracker, and I read every single one. Let me give you the analogy that I think makes this click immediately. Imagine a coat check at a very busy restaurant. The coat check has 100 hooks, but over the course of a busy night, the staff have handed out 400 tickets. Most of the time this works fine. Not everyone comes back for their coat at the same time. Some people forget. Some people leave early without asking. The coat check has operated this way for years without incident. Now imagine that a competitor restaurant 2 streets away is offering to buy coats, any coat, any style, for 6.5% above market value. Suddenly the staff start noticing that people are actually coming back for their coats. More than usual. The hooks are emptying, and the outstanding tickets have not gone down. That is the COMEX silver market right now. The Shanghai premium is a competitor restaurant buying coats. The arbitrage traders are the people coming back for their tickets. And the hooks, the registered inventory, are getting emptier every week. The coat check does not collapse the moment it runs low, but becomes a lot more sensitive to any sudden rush. One piece of news, one data release over weekend, one unexpected delivery demand from a large institutional player. Any of those can turn a slow grind into a very fast move. If you know someone who's been following the silver squeeze story and wants to understand the actual mechanics rather than the hype, share this video with them right now. This breakdown took real time to put together. Now let me talk about the $86 level, because this is a number the article flags as a short squeeze trigger. I want to be honest about both why it matters and why you should not treat it as a guaranteed launching pad. The reason $86 is significant is structural. As I mentioned, COMEX front-month futures are sitting at $84. If silver pushes through $86 on meaningful volume, two things happen simultaneously. First, traders who are short silver futures, betting on the price going down, start hitting their stop-loss levels. Their risk management systems automatically close their positions. That means they have to buy contracts at close, which adds buying pressure to the market at exactly the moment price is already moving higher. Second, the move above $86 starts pulling the COMEX price closer to the Shanghai physical price. As that gap narrows, the arbitrage trade becomes less attractive. Metal stops moving east as aggressively, which means the pressure on registered inventory, which has been the slow leak driving this whole story, starts to ease. When I pulled up the CFTC data from the most recent commitment of traders report, managed money short positions have been declining as the cost of holding shorts against a persistent physical premium has become increasingly difficult to justify. The professional money is already reducing its short exposure. The question is whether that reduction accelerates into a disorderly squeeze or happens in an orderly control way. In 15 years in these markets, I have seen both. The orderly version is a steady grind higher. The disorderly version is a vertical move that overshoots and then corrects sharply. Neither is guaranteed. Both are possible from the current setup. Here's the part we want to be honest about, though, and this is where I will say something the pure bull channels will not. The $86 trigger works both ways. If silver approaches $86 and fails, if it hits that level and gets rejected, the traders who are waiting for confirmation of a squeeze see that confirmation denied. That can produce a sharp reversal lower, as those same stop losses trigger on the long side instead. The level is significant precisely because it is a decision point, not a guaranteed direction. Let me add the macro and geopolitical layer, because it is directly relevant to the squeeze risk this week. The U.S. 10-year Treasury yield is sitting at 4.17%. The article notes that a spike to 4.5% could produce a flash crash in precious metals before a rebound. I want to unpack that because it sounds alarming, but the mechanism is actually straightforward once you understand it. When Treasury yield spikes sharply, institutional players who are holding leveraged positions in commodities, including silver futures, sometimes face margin calls. Their broker requires more cash to maintain the position. If they cannot post the cash immediately, the position gets liquidated automatically. That liquidation sells silver into the market, regardless of what the physical fundamentals look like. Think of it like a tenant who has put down a small deposit on a large apartment. The landlord suddenly doubles the deposit requirement overnight. The tenant did not do anything wrong. The apartment did not get worse. But they either come up with more cash or they move out. A margin call in silver futures works the same way. The metal does not change. The position gets closed because the financing cost changes. This is why the article uses a phrase flash crash before rebounding. The liquidation event is temporary because it is driven by financing mechanics, not by any change in the underlying physical supply and demand picture. For British investors specifically, the Bank of England's interest rate path matters here in a directly practical way. If the Bank of England moves rates in a direction that strengthens sterling against the dollar, UK investors holding dollar-denominated silver assets see their sterling returns compressed even if the dollar's silver price rises. The LBMA, the London Bullion Market Association, publishes daily silver price data in both dollars and sterling, and is worth tracking both if you are a UK-based holder. The Royal Mint has also flagged in recent months that UK retail demand for silver has remained elevated, which mirrors a pattern we are seeing in the broader physical market globally. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market. Open interest at 400 million ounces. Front month futures at $84. Managed money shorts declining per the most recent CFTC report. The $86 squeeze trigger level in play. The paper lane is under structural pressure from the ratio itself. 4-to-1 paper physical is not a number that resolves comfortably if physical demand continues. Lane 2 is the physical market. Registered COMEX inventory at approximately 100 million ounces and under sustained pressure from the Shanghai arbitrage. Shanghai holding above $88. The 6.5% premium keeping the east-west metal flow active. The physical lane is not just strong, it is the engine driving the entire story. Lane 3 is the macro picture. 10-year Treasury yield at 4.17% with a potential spike to 4.5% as the key risk trigger for a temporary liquidation event. Dollar elevated but failing to suppress silver meaningfully. Thin futures liquidity. The article specifically flags this, meaning that moves in either direction can be larger and faster than normal because there are fewer participants willing to take the other side. In 15 years watching currency and commodity markets, the times I've seen all 3 lanes align the way they are now, paper under structural pressure, physical actively draining, macro uncertain with a specific identified risk trigger, those have historically been some of the most consequential setups in these markets. I am not saying this is guaranteed to resolve in any particular direction. I am saying the conditions for a significant move are present in a way that does not show up often. When paper is stretched 4-to-1 against physical, the physical lane is actively thinning the vaults, and the macro lane has a specific yield level that could either accelerate the squeeze or temporarily interrupt it. History says you want to be watching carefully. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, the 10-year Treasury yield. Specifically, does it hold below 4.3%, or does it push toward the 4.5% level flag in the article as the flash crash trigger? Here is why this is the one number that controls the direction of everything else in the short term. If yields stay contained below 4.3%, the margin call risk for silver long stays manageable, the physical premium holds, and the slow grind toward $86 continues with the squeeze potential intact. If yields spike through 4.3% toward 4.5%, watch for a sharp but temporary silver sell-off, the margin call liquidation event, followed by a potential fast recovery as physical buyers step in at the lower price. I will be watching the daily Treasury yield print from the U.S. Department of the Treasury every morning this week. If we close above 4.35% on any single day, that is my early warning signal that the flash crash scenario is moving from possible to probable in the near term. This is my one call for the week. John, FX Insider. On record, I will be back next video to tell you exactly what the yield did and what happened to silver when it did it. No edits. No excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that. Here is what needs to happen for the optimistic picture to develop. Silver needs to push through $86 on volume. Managed money shorts need to cover in size. The COMEX Shanghai gap needs to narrow from a COMEX side, meaning New York prices rise to meet Shanghai rather than Shanghai pulling back. If that sequence happens, the article's target of a vertical move is not unreasonable. The mechanism is real. The fuel 400 million paper ounces against 100 million physical. Is there? Now here's the honest, cautious picture. Treasury yield spiked to 4.5%. Margin calls forced broad liquidation of leveraged commodity positions. Silver drops sharply toward the $75 area before the physical buyers step back in. In that scenario, the squeeze story does not go away. It just gets delayed and potentially provide a lower entry point for those with dry powder. The thin liquidity the article flags means slippage is a genuine practical risk in both directions. If you are trading a leveraged position in this environment, the bid-ask spread and execution quality matter more than usual. If you are holding physical or unlevered ETF positions, the liquidity issue is less immediately relevant to you. Both the bull and bear scenarios are genuinely possible right now. Your job is not to pick one. Your job is to watch the yield, watch the $86 level, and watch the CME warehouse report each week. The market will tell you which story is developing. You just have to be watching the right indicators when it does. Before we close, the disclaimer you need to hear, and I mean it, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers. First, does the 4-to-1 paper-physical ratio change how you are thinking about your silver exposure right now? And are you holding physical, ETF, or futures? Second, the two scenarios I laid out squeeze through $86 versus flash crash on a yield spike to 4.5%. Which do you think develops first, and what is your reasoning? Drop both answers below. I read every single one. Subscribe, because next week we're going to exactly how to read the CME warehouse reports week by week. I'm going to show you the specific numbers to track, what the trend lines look like right now, and at what inventory level the coat check stops being able to function normally. That is a skill worth having, and it is completely free information that most retail investors never look at. And if someone in your life is trying to understand why silver is behaving the way it is right now and not getting straight answers, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.